Today we're going to break down the two main types of futures contracts, E-mini and micros. We'll go over what they are, how they're different, what they have in common, and most importantly, which one might be the right fit for your trading. By the end of this video, you'll understand contract sizes, tick values, margin requirements, and how to use them depending on your account size and goals. There's two different types of futures contracts, E-mini futures and micro futures. E-mini futures were introduced in the late 1990s, and micro futures were launched in 2019. They're 1/10 of the size of E-minis, small notional, lower margin, but beginner friendly. So first we'll go over the similarities of these. They're all electronically traded on the Chicago Mercantile Exchange. They all follow the same underlying price movement. They all have near identical tick structure, just different dollar values, and they all settle and expire the same way. Even though there's many similarities with these, it's important to understand the key differences, which is going to come from the tick value. So here we have the mini S&P chart up. Every tick is going to be $12.50. If we wanted to trade micros, we would type in MES, go to the front month, and you can see that it's trading at the same price, but the tick value is 1/10 of the E-mini. So every tick movement in this market is $1.25. Micros require far less capital, letting smaller accounts participate. In terms of who trades what and what market is most suitable for you, minis are going to be traded by professional retail and prop firms, whereas micros are going to be retail traders and smaller retail traders, and also strategy testers. So what are the pros and cons of each, and what should you trade? So micros are great because they offer lower risk and they're great for practice, but one thing you need to be aware of is that your commission can eat more of a percentage of your profits. Once you are developed and you have a strategy and also a larger account balance, E-minis will provide a balance between size and cost, making them ideal for developed strategies. So if you're just beginning or testing a new strategy, micros are going to be where you want to trade. If you're growing your account and want efficiency, typically you'll be trading the minis. And it's not necessarily about which is better, but which matches your risk, capital, and goals. If you need a list of available products to trade, you can head over to cmegroup.com and look up equity index futures. Here we have the E-mini S&P, NASDAQ, Russell, and so on, along with the corresponding symbols for micros. We still have E-mini or micro E-mini S&P, NASDAQ, Russell, along with the symbol. Once you have your symbol and the product that you want to trade, you can head over to Optimus Futures Web, type in the symbol. So if we are looking to trade micro NASDAQ, we could type in MNQ, go down to the front month, and now we have the chart of micro NASDAQ, same with the micro S&P if we want that. Here's an example of what your estimated margin requirements might look like, and of course this is going to vary from broker to broker and also subject to change at any time. But if you're looking to trade something like the E-mini S&P, you might have an initial margin requirement of $21,000 as compared to the micro S&P at $2,100. So these numbers can vary drastically depending on the market that you're trading and what your goals are. While there might be a small tick difference between micros and minis, they still move very closely together. It's just about finding the size that lets you trade with confidence and something that works within your account balance. You can test them all risk-free on Optimus Futures Web at demo.optimusfutures.com.